Hey everyone, it's Richard. You're watching The Plain Bagel. Today is the day that we see the first company cross the finish line in the AI race to go public, with Elon Musk's SpaceX, the company whose prospectus reads like a science fiction book, complete with pictures for easy reading, officially start trading its shares publicly under the ticker SPCX, breaking records and making Elon Musk the world's first trillionaire. And depending on who you ask, it either signals the start of the retail investor AI golden age or the beginning of the end of the AI bubble. You see, this was just the first of three massive AI-focused IPOs that we're expected to see this year, with Anthropic, the company behind Claude, itself having filed confidentially earlier this year to go public, likely sometime in the fall, and OpenAI, the company behind ChatGPT, announcing just this week that it too had filed its S1 with the SEC. And as mentioned, these IPOs are breaking a number of records for SpaceX beyond just the massive market capitalization. There's also the fact that the company put aside a record percentage of its shares to give retail investors access to its IPO. And with Anthropic and OpenAI themselves having previously been valued just shy of $1 trillion each, the three companies together are set to raise more money by going public than all other US IPOs combined since at least 2022, with total proceeds from IPOs in 2026 expected to blow previous years out of the water. All of which is remarkable in its own right, but especially so when you consider how relatively small and unprofitable these companies are. Of the three companies, Anthropic is the only one on track to see profitable operations this year, with SpaceX actually losing money at the operating level, and these companies spending well beyond their revenues investing in scaling out, with OpenAI set to spend $600 billion by 2030 on compute spend compared to its annualized revenues of just $25 billion. So it's easy to see why these companies are scrambling to go public. They need a heck of a lot of money, and public markets offers another faucet through which they can access that capital. But given how heavily focused these companies have been in specifically targeting retail investors with their IPOs, it's raised some concerns that these companies will soon be burning through the pensions and life savings of everyday investors to fuel their AI money furnaces well before even demonstrating a viable business strategy, with SpaceX specifically turning a lot of heads with its abnormal prospectus, which could very well go down in history as one of the most bizarre ever seen, with the company advertising itself as a bet on Mars colonization, enterprise AI, asteroid mining, and data centers in space, while also putting forth the company's mission as, quote, to build the systems and technologies necessary to make life multiplanetary, to understand the true nature of the universe, and to extend the light of consciousness to the stars. Now, I don't know what extending the light of consciousness to the stars entails, but I imagine it has to do with that Joe Rogan episode he was on back in 2018. Regardless, given the concerns of an AI bubble seemingly pulling public investors deeper into it, I wanted to cover the topic to discuss the IPOs and the details we have, the broader implications for the market, and things you yourself should consider if you're hoping to use one of these companies to go to the moon, whether figuratively or literally, since space tourism is another one of SpaceX's hypothetical business lines. And the first half of this video will really be focused on SpaceX since we have the most details about that company now that it's public, but I'll leave chapters in the description down below if you want to hop to the different sections of today's topic. SpaceX, as you might be aware, was a company started and mostly controlled by Elon Musk that, as the name implies, is heavily involved in the space industry, where it's actually built a decent name for itself. The company is famous for its rockets, having pioneered techniques for reusing rocket boosters, and holding a dominant position in the space launch industry, representing 80% of global mass to orbit since 2023, and its connectivity business, aka Starlink, where it offers internet access via satellite connection, is actually a fast-growing, profit-making business. However, earlier this year, amid the AI hype, SpaceX decided that it was going to get in on the action, with Elon Musk combining it, or more specifically using SpaceX to acquire his other company, xAI, known for the social media platform formerly known as Twitter, and the AI formerly known as Mecha Hitler. with the AI segment making up about 17% of the company's total revenues, but managing to take up the majority of the company's capital expenditures, with its spending quickly dominating the rest of the business, which is why the company is being brought up in this broader discussion of the AI gold rush. Now, with this IPO, SpaceX is actually only selling 4.2% of its company stock, represented by 555.6 million shares roughly, meaning that most of the company will continue to be held by the private investors who owned the business before the IPO, with Elon Musk himself retaining 42% of the company's equity before dilution. And at an IPO price of $135 per share, the company is set to raise at least $75 billion from the share sale, all of which makes SpaceX the largest IPO capital raise on record, with the company set to exceed its original market cap objective of around $1.75 trillion, which will actually lead to it displacing Elon's other business, Tesla, as the 8th largest US company by market cap, which is remarkable given that the company's revenue doesn't even crack the top 200 list, which brings us to the first reason why many are viewing this IPO as absurd. SpaceX essentially hit the market with a price-to-sales ratio of over 90 times, which puts it well above most other publicly traded tech companies. Google and Meta, for example, who themselves have AI businesses and are actually profitable, trade at price-to-sales ratios of around that 10 times level. And while these rich valuations are typically justified by higher growth rates, historically anyway, that's not what we've seen. SpaceX's AI segment isn't even its fastest growing segment internally, with the business growing just 12.5% year over year in the latest quarter, with revenue for the company as a whole increasing just 15.4%, well below the revenue growth rates seen by its competitors. However, most of SpaceX's valuation is very clearly being tied to its future potential rather than how the business stands today. In fact, Morningstar analysts have argued that based on current performance, SpaceX is worth less than half of what it's IPOing for. So it's really what Elon Musk has planned for the business that has investors excited. But that brings us to another absurd aspect of this IPO, where the company lays out the roadmap for its future: the firm's prospectus. You see, when companies IPO, they submit what's called an S-1 form, in the US anyway, to the SEC for review, a document that contains all the necessary disclosures and information so that investors can make an informed decision when they buy into a company. And in conventional Elon Musk fashion, the SpaceX prospectus has been pretty unconventional. Right off the bat, investors have to scroll through 11 pages of pictures of rocket ships and other space tech before they even get to the table of contents, which I suppose is fitting since it's quite common for people to throw in a bunch of random rocket ships when they're trying to pump something. Now, not long after this, we're faced with a quote from Elon Musk philosophizing about being a spacefaring civilization, and of course, the company's Star Trek-esque mission statement. Now, in addition to a number of these grandiose statements being made throughout the document, the prospectus also includes a number of moonshot business ideas. Literally, because most of them involve carrying out operations in space for some reason, including traveling around Earth via spaceship, space tourism, in-orbit manufacturing, traveling to Mars and setting up businesses there, building in-orbit data centers, and developing human augmentation systems. A good chunk of which, by the prospectus's own admission, is science fiction, since the technology for many of these things is either unproven or non-existent. Now, with all of SpaceX's focus on space, you'd be forgiven for forgetting that SpaceX is an AI business. But to convince the non-believers, the prospectus includes an outline of the business's total addressable market, essentially what it sees as its future revenue potential, with 93% of this amount being derived entirely from its artificial intelligence opportunities, namely enterprise applications. Now, beyond those mistaken for thinking we're talking about a rocket company here, these figures might surprise a number of people. For one, the total addressable market is about the size of the entire US economy. And regarding enterprise applications, most view Grok as a mere extension of the X social media platform. In fact, even internally, the company actually combines many of its operating figures for both the X social media platform and Grok, seemingly demonstrating that its use is primarily for social media. And I don't know that many enterprises are keen on integrating an AI model known for undressing people on X into their workflows. The one business case the company did put forward in its marketing material of Grok being used for an enterprise effectively chalked up to being a glorified Google Translate, which doesn't really demonstrate this massive potential. And the idea of Grok as being a contender with Anthropic and OpenAI regarding this sort of enterprise application hasn't really been helped by the recent announcements from the company that it would be renting out compute power to Anthropic for $1.25 billion a month and Google for $920 million a month. Because while these deals might prove lucrative if they follow through, given that they alone would actually double SpaceX's revenue from 2025, it's a bit confusing from a company that's claiming Grok's going to dominate the space when it's renting out its capacity to other AI models that are more known for those enterprise applications. So you can see why the SpaceX IPO has raised so many eyebrows. Beyond just the sheer scale of it, the way the company is being marketed is just entirely different from the company investors are actually buying into here. And that's without getting into the other quirks that come with this. The fact that Elon will be retaining 85% of the voting rights over SpaceX, thanks to having a special share class that has 10 times the voting rights of Class A shares. A good chunk of the proceeds from the IPO simply going towards paying off existing obligations, despite the company marketing that it will go towards developing its business. The story that Musk actually required companies working on his IPO to subscribe to Grok, and as mentioned, the company being heavily focused on garnering retail investment, with SpaceX opting to reserve up to 30% of its shares for individual investors, compared to the typical 5 to 10%. And the company even launching a retail side website, SpaceXIPO.com, where it provided investor access to the company's prospectus, roadshow presentation typically reserved for institutional investors, and a fact sheet, and listed out all the brokerages where individual investors could go and access IPO shares. So in the context of the great AI IPO race, this one really takes the cake in a number of ways. Now, regarding the two other IPOs here with Anthropic and OpenAI specifically, we don't yet have that many details on these companies' operations. While a number of details around revenue and the like has been leaked by private sources, the companies have filed their prospectuses confidentially, meaning the SEC is reviewing it privately before it's released to the public. But what we do know is that with recent private funding rounds, Anthropic has been valued at $965 billion and is set to hit $10.9 billion in revenue during the second quarter, which could actually set the company up for its first operationally profitable quarter. And OpenAI has recently been valued for $852 billion, with management for OpenAI similarly highlighting a desire to reserve a sizable portion of their shares for retail investors. And the thing is, these aren't even the only companies going public here. While they certainly are the largest and most notable, given that OpenAI and Anthropic have been sort of competing head to head to be the largest pure play AI business, we've already had a number of companies in the ecosystem like CoreWeave and Cerberus go public recently, and companies like Anduril, Cohere, and Databricks themselves eyeing IPOs in the near term. And even among currently public companies, we have businesses issuing shares. Google's parent Alphabet, for example, recently announced plans to sell $80 billion worth, on par with SpaceX's own capital raise to help fund its AI ambitions, with Meta itself considering a similar move. So you can see that a lot of companies are rushing to raise money from investors to help fuel their intensive spending to build out their AI infrastructure, either for their own use or for their customers, and compete for that dominance in the industry, which has led to some raising concerns that these IPOs represent a way for private investors to exit and cash out right at the top of the hype, that we're democratizing access to these companies right before the bubble pops. With SpaceX, for example, given that the public float is going to represent less than 5% of the entire company, there are concerns that the stock could experience meaningful selling activity from insiders as their staggered lockup periods expire, with nearly $1 billion of shares set to unlock within the next couple of months alone. And given a number of actions from key players leading up to this IPO, it seems increasingly likely that individual investors will end up as the exit liquidity for some of these insiders. Beyond SpaceX itself focusing on giving access to the retail base, we've also seen brokerages like Fidelity, for example, actually lower its capital requirement from $500,000 to just $2,000 to give smaller investors more access to this IPO, with it being quite typical for IPOs to only be accessible by larger investors. There's also been the story around index companies like NASDAQ and the FTSE Russell, which each eased their criteria for index inclusion, allegedly at the request of Elon Musk himself, to effectively fast-track SpaceX's inclusion into some of their flagship groups. Something that could see SpaceX join indices like the NASDAQ 100 within its first 15 days, which is unprecedented and something that would lead to automatic buying of the stock from funds and investors who passively follow these indices. Meaning, regardless of how people feel about the AI bubble or SpaceX, they could start seeing it included in their 401k or pensions. Now, the optimistic framing of this is that democratization piece, right? Giving individual investors unprecedented access to what is seen as a technologically innovative company on its IPO. And in Elon's case, it does seem like a smart move to bolster his company's valuation. He has a massive social media following that in part includes a bunch of retail investors, and he's known for his unconventional approach to public relations, which, combined with the company's grandiose aspirations, makes it a good contender for meme stock status, which we all know from our Corporate Finance 101 class is a tried and true strategy for capital raises. But the pessimistic view, of course, is that this introduces a lot of risk to everyday retail investors, at times whether they want it or not. Elon Musk is, of course, no stranger to controversy and has a history of things like self-dealing, even with SpaceX itself, something that's not helped by his retention of majority control. And the man doesn't have the best track record on following through with his promises. In fact, we recently had a piece from the New York Times analyze Elon Musk's success rate on his ambitious goals, which found that of the 602 objectives set over the past couple of decades, only 19% were actually achieved, with 35% being late or failing to deliver, 13% being outstanding, and a third just being too vague or difficult to assess. A higher retail concentration also makes the stock more susceptible to price volatility, something admitted by SpaceX itself in its prospectus. And that could eventually impact future capital raises for the company. It's actually why a lot of companies that are pursuing high growth, innovative industries and are unprofitable often remain private to avoid the regulatory burden and the public investor scrutiny. The sheer size of these IPOs has also raised concerns about the crowding out of investments in other areas and even within the tech scene itself. One of the reasons many are describing this IPO mania as a race to go public is because each subsequent company to release and debut its shares is likely to face a smaller and smaller pool of available or even interested investor capital. Truth is, there's only so much money to go around. Some have even speculated that the sell-off in Bitcoin represents investors selling their ownership to raise capital for these investment opportunities. But it's questionable whether there's enough investor appetite or dollars available to allow all these companies to meet their objectives, especially when we're seeing treasury yields floating closer to that 5% level. If that figure rises higher, it could discourage stock market investing and valuations. It's why many people are watching the SpaceX IPO so closely, as the largest IPO on record. It's going to help set the mood for the other companies going public later this year. Finally, there are the grander concerns about this all being part of a bubble. The S&P 500 already sits at a price to earnings ratio of around 31 times and has become increasingly concentrated among tech companies, with the top 10 stocks, the majority of which are somehow involved in the AI ecosystem, representing nearly 40% of the entire index. So any correction could be far-reaching in terms of its impact on the market and investors as a whole. And while the S&P so far hasn't changed its criteria to allow these companies to enter the S&P 500, their hypothetical inclusion would only make this concentration worse. And with these companies having such rich valuations, it leaves very little margin for error if AI doesn't live up to its full potential. Goldman Sachs, for example, one of the investment banks behind the SpaceX IPO, has argued that SpaceX could see its AI revenue grow by 100 times over in the next 4 years, demonstrating some pretty exuberant expectations for technology that, while certainly promising, hasn't yet demonstrated that long-term business sustainability. One survey by McKinsey released in November found that 88% of respondents already use AI in at least one business function, with nearly 31% scaling their use. But so far, just 39% report an impact on enterprise earnings before interest and tax from their AI use. So while AI use certainly seems set to grow, it's questionable whether rates will continue at their current blistering pace, especially with 30% of survey respondents having experienced inaccuracies at least once with their models. And all that adoption is with AI companies taking a loss on their operations. Eventually, they'll have to charge a sustainable price for their offerings. We're already seeing a number of companies move towards a token consumption pricing model that basically charges users based on how intensive their request is. And it's yet to be seen whether AI adoption will justify these higher prices in the long term. Now, the flip side to all this is that this is a technological revolution. These models are rapidly improving. The companies are already seeing meaningful revenue growth, and all of this justifies the hype and the valuation, which is certainly possible. The issue with technological revolutions is that they're pretty hard to track or predict. But with these companies, again, being priced for perfection, a lot of that upside is being priced in, which leaves investors with a lot of risk. So it's up to you whether you decide to invest in SpaceX or Anthropic or OpenAI. Certainly, if the near-term revenue growth these companies have seen continues into the future, they could prove quite attractive. And there's no denying the impressive technological feats these companies have achieved and could potentially achieve in the future. And with SpaceX specifically, some people like the Elon factor, from his political takes to his truck designs. His company Tesla has managed to retain a rich valuation in spite of falling earnings and slowing revenue growth. And some are optimistic that with grand objectives like the joint venture Terafab, where the company plans to make a massive semiconductor factory, and grander objectives of going to Mars, that Musk will somehow find a way to not only make these ideas work, but also make a bunch of money in the process. But it's hard not to be skeptical around how profitable these companies might end up being, especially when you talk about the goals that some have set for themselves. So as innovative as these companies have been, there's also no denying that they present meaningfully higher risk than your typical mega cap stock. And just like Musk's predictions that we would have a 1 million robotaxi fleet by 2020, and that SpaceX would reach Mars by worst case scenario this year or by 2031, it's worth taking these visionary promises with a grain of salt when you're the one funding them. Anyway, that's the video. Thanks for joining me today. I hope you found it helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the SpaceX IPO or the general AI IPO race. Thanks again for joining. And as always, be safe out there.